Good morning, everybody. Welcome back to another episode of Smart Biz Advisors. I'm your host, Jon Jones, and I'm joined by always by my co-host, Mr. Mark Fackrell. Good morning, Mark.
Good morning, John. Nice to speak with you as always.
Nice to see you too. Today, we're delving into a crucial topic for our self-employed listeners who are navigating the home buying process and they're considering their options. So we know that this is a kind of exciting, hot time. A lot of talk about buying a home in this market at the moment, and so I thought this would be a great topic to share with our listeners, especially because both of us, Mark, own homes in this market, and in your case, in particular, are actively you have ongoing recurring income from your homes that you own. So with that said, what I'd like to do is ask you to kind of run down the situation in the current market there in the United States. You happen to be in Florida, but you have experience in the West as well. I'm originally from Colorado. That's where my home is. Tell us. Let's start out for the listeners who might also own a home or are considering purchasing one. Tell us about you know, some of the basics. What do self-employed individuals need to consider? What are the hot topics, the issues when it comes to buying a home as an entrepreneur?
Sure. So, everybody who has bought a home and financed it understands that, it can be kind of a challenging situation. I mean, it's a stressful time for everybody, right? And it's kind of a daunting task for everyone when they go to undertake it.
Mm,
It's even more so when you're self-employed,
mhm,
because the process just becomes a lot more complicated, right? I mean, it's certainly doable, and it's absolutely something that you can navigate your way through, but it's more challenging than, if you go to your lender and hand them your W-2 and say, hey, this is what I make.
mhm.
um, as a self-employed person, it becomes a lot more complex of a situation. So I think that it's worthwhile to spend a little bit of time just kind of going through, what those complexities are and how to overcome them. We talked a little bit last week about some of the pros and cons of entrepreneurship,
Yes.
and this probably falls into the con because it makes it more difficult to go through this process. But just because it makes it more difficult, it certainly is not insurmountable, and there's a way around it. And so the whole purpose of what we're going to talk about today is just getting people a little bit more prepared to be able to go through that process.
Okay. Certainly. Yeah. So, uh, take us along this road where we have a business, whether it be services or physical goods. Maybe things are going well, and for whatever reason, we are interested in purchasing a property, whether it be to live there, to rent it, whether it be an investment. What are the things you need to do to prepare to do such a thing?
Okay, so it's important to recognize the difference between a house that you're going to live in and a house that you're going to purchase as an investment property. I
Okay.
think that for the purpose of this conversation, I think that we should kind of stick with, what are we going to do to get qualified for a house that we're going to live in. I think we could probably spend a whole nother episode talking about how we might want to do this if you're purchasing a property for investment purposes.
Yeah.
Um, but or maybe we can dive into it later on in this program too. But for right now, let's just talk about, I'm going to buy a
Let's
new
do it.
house.
Okay.
So one
All
of the
right.
key things as a business owner that you've got to take care of is you've got to
Yep.
be able to have good documentation that shows where your income is coming from. So this is what I talked about before. If you've got a job, you just hand them your W-2. you send them a couple weeks worth of pay stubs and they're good to go.
Yep.
Your income streams are a lot more complex when you're self-employed. So one of the critical things for this is going to be able to document everything. You've got to separate your business income from your personal income. You've got to have your set of books. So this ties back into what we've talked about already. You've got to keep a good set of books for the business, right? And then you've got to be able to clearly show and document the money that is coming to you as the business owner, whether it be in the form of a W-2 or whether it be in the form of distributions or whatever it is. You've got to clearly be able to have this package of information, show it to your mortgage broker or your loan officer at the bank and say, this is how much money I made and this is how much money the company made.
Okay.
So the documentation is very clear. So the more clearly documented you have your income, the better life is going to be for you. The next part of it is going to be understanding what your options are. There are a whole variety of different loan options out there. So a lot of people just think of a mortgage. It's, something I go to the bank and I get, and they, buy my house with it. There are actually several different ways, and there are some that are more suited for business owners than others. Which we can dive into that a little bit more.
Definitely. So you already touched on, demonstrating financial stability and proving your credit worthiness, right? These are the things that you have to do straight away.
Yep.
Yeah.
Yeah. So demonstrating the income is what I just talked about. So that's, having good documentation that shows where the money's from. Credit score is obviously going to be important. So you just need to make sure that you keep your personal credit score where it should be. Make sure that you're doing all the things that you need to do, pay your bills on time, things like that.
Yeah. And that really does impact. It really does impact.
It really does impact. Interestingly enough, there are some loan types where your credit score is not as important, which we can talk about.
Yeah. So let's go discuss those. So you mentioned both. So we have traditional mortgage routes, the traditional business home loans, and then we have some other options. So can tell us about both.
So you have a traditional mortgage, which, people that have gone through this process are pretty familiar with this. It's either, a conventional loan, you'll come up with 3 to 5% for your down payment. You submit your documentation to the loan officer and then they approve it or they don't approve it. So that's the standard type of loan that most people use when they buy a house. We've got a couple of other options. We've got bank statement loans, which is great for entrepreneurs. And so what they do in a bank statement loan is they actually just you have to submit them 12 months or 6 months worth of bank statements, both for you and for the business. And they just look at the number of deposits that come in each month. And that's how they determine what your income is.
All right.
So that simplifies the process pretty significantly. I mean, it's kind of work to gather up all that information, obviously, but once you've got it and you submit it to them, and they can pretty clearly see what your actual income is. So they look at that in comparison to your, debts that you have that are on your credit report, and they come up with your debt to income ratio.
Mm-hmm.
It's probably worth talking a little bit about what a debt to income ratio is. People hear that a lot, but I think there's a lot of uncertainty as far as what that means. Sure. It's not how much money you actually owe. It's how much money you make versus what your payments are every month. So if I owe $200,000 on a house, but my payment on the house is only, $1,100 a month, the thing that they look at is the $1,100 a month. They don't look at the $200,000 debt.
Okay. All right.
So then what they do is they'll go through and they'll look up all of your payments that you have to pay every month. They'll see that your mortgage is $1,100, your car payment is $500, your student loans are $200. Your credit card bill is $150 a month. So they'll add up all of those things that you owe every month, and they will compare that with the amount of money that you bring in every month. and that is your debt to income ratio.
Okay. And just quickly, is there any kind of rule of thumb or kind of gauge that people would be interested to know about? Or is that a different?
There's absolutely a rule of thumb. So
Yeah.
I can't remember
Interesting.
exactly what I can't remember exactly what the numbers are. This is something that you'll want to talk with your loan officer that you
Hmm.
work with.
Hmm.
But it's 50% is usually what it is for most loans. So if your debt to income ratio is below 50%, then that puts you in a good spot to be able to purchase a house.
Okay. Okay.
Sometimes it can go up to 60, but it really just kind of depends on on the kind of loan that you're going for.
All right. That's good to know. Okay. So you bank statement loans. What other kinds?
So another one is a private mortgage. So it's called a private lender. Basically, most loans that you will get from a bank, you know, they write the loan and then they could sell it. I mean, a lot of people that own houses have experienced this, where they'll go buy a house and then 4 months later they'll get a letter from the bank saying that their mortgage has been sold, and then 6 months later they'll get another letter from the bank saying that their loan's been sold to somebody else.
Oh,
So that's pretty
okay.
common if you know, go the traditional mortgage route. There are other people out there and companies that actually just write the loans themselves and they hold it forever. And so, since it's not a situation where it gets put out on the market and bought and sold with other people that, you know, invest in these sorts of things, they do it all themselves, and so they have less strict requirements. They might be able to give you some leeway on your debt to income ratio, for example. They might be
Hmm.
able to give you some leeway with, you know, what your income is. If you've got some issues with your credit, you know, and you can explain what those are, they may be able to work with you on that. I guess the point that I'm trying to make here is that with these private lenders, there's
Hmm.
more flexibility than there is with a traditional mortgage.
Okay. That's key, and that's very interesting. Just because it's so fascinating, where does one access this kind of option?
There's tons of companies out here that do this, and it's
Okay.
just a matter of, you know, go out and do a Google search, you know, look
Okay.
up, you know, private money lenders, private money mortgage lenders,
Okay.
bank statement loans. And then, you know, it's like with anything else. If you're doing something that's a big ticket, you know, sort of situation, you know, talk to a few different people and work with somebody
Mm,
that you're comfortable with,
mm,
and make sure that they're going to work with you, right? So there are a ton of different options out there. There are a ton of different brokers. So find somebody that, you know, you've got a good rapport with, somebody that responds to you,
yeah.
somebody that you're going to be able to work with well, and they will help you navigate the process. And don't be afraid to ask people questions, right? I mean, this is the whole reason that these people exist, is to, you know, the reason they get paid is by helping you write a loan. So um, be comfortable
Absolutely.
with it and ask
And
questions. Ask questions.
great. Yeah. Your, it's definitely worth mentioning that you are in this process right now. You're considering purchasing a new home, selling another one. Uh, so you are up to date on these things. And so our listeners could potentially benefit from that. So appreciate you sharing your own personal experience. So other than those two that you just mentioned, are there any others?
There is something called a DSCR loan, which is directed more towards investors. And so
Mm,
the nice thing about a DSCR loan is it doesn't matter what your credit is. They don't look at your credit. What they do is they base the ability to service the loan on the cash flows that the property will generate. So I'm looking
uh,
at buying some vacation rental properties,
yes.
and what you do is you find the property and you say, okay, this house costs $300,000 and it'll generate $50,000 a year worth of rental income.
Hmm.
So you take those two pieces of information, you go to a DSCR lender and you say, I want to purchase this property. It generates this amount of rent. And then they will look at it and say, okay, we believe that the cash flows from that property will actually be able to pay off the mortgage.
Wow. Yeah.
So
It's
they don't look at your personal credit. So it doesn't matter. And this is, this is really kind of the only way that you can purchase. Well, it's not the only way, but it's one of the primary ways that you can purchase investment
Mhm.
properties beyond having, a traditional mortgage. I think you're only allowed to have 5 mortgages. So if you get 5 mortgages, the next way to do this is to go do a DSCR loan, because they don't care about what your credit score is. These require a little bit bigger down payment than a traditional mortgage does. So rather than 3 to 5%, you're going to need 20 or 25% for these.
Okay. All right. Yeah, that's interesting. I had no idea. 3 to 5% actually seems quite reasonable, small even. It's definitely something that you wouldn't have imagined being the case. It, very, very interesting. So DSCR loans, just another Google search, or do you have any main player that you'd recommend or that you know of, or where do you find this loan?
I mean, I would suggest that people just Google it. I mean,
Okay.
it's lenders are specific to your state, right?
Mhm,
So,
mhm.
find somebody that's local. There are larger brokers that will broker DSCR loans all around the country too, but I would generally say go with a local option.
Okay. All right. So that said, we already know about, your credit worthiness and your financial stability. Now you've just gone through several varying loan options. Now, Mark, could you share some steps our self-employed listeners should consider to prepare effectively for applying for those loans? How does that what are the key considerations when you're actually applying for a mortgage?
So again, one of the probably the primary key consideration is make sure you have good documentation of what your income is. Um, Everybody's going to know, based on your credit report, what your expenses are. So that's something that, they are well aware of. You're not going to have to do a whole lot to document that. You're definitely going to have to document your income and be able to show what it is that you make. So have good documentation. Make sure everything is tracked separately. Make sure you can prove what your income is. Keep your credit score in a good condition. Um, a down payment. The bigger the down payment, the better. I mean, almost always that's going to be the case.
All right.
You're going to want to be aware of your different loan options. You're going to want to consider the type of a loan, right? I mean, they've got fixed rate loans, they've
Yeah.
got adjustable rate loans,
Yeah. Okay.
and it's important that you understand what these are, um,
Yeah. Yeah.
and
Can you
again,
tell
ask
us?
questions.
We know that the adjustable rate is may be ideal in a low interest environment, but in maybe one where the interest rates were rising, it'd be less ideal. Is that accurate?
So in a low interest rate environment, a fixed
Yep.
rate is always the best. So we've actually got, we're sitting in a situation right now where the interest rates are higher than they have been in several years.
Yes.
We've got a ton of people that got. I mean, I have a good
And
example of
tell us.
this. The house that I own in Idaho, I've got a 4% interest rate on, and it's like
So that's
that's
good, right? That's
yeah,
pretty good, right?
that's extremely good. So
Mhm.
right now interest rates are between 7 and 8%, which makes it a little bit more challenging. So, typically what you would consider in a situation like this is an adjustable rate mortgage might be a better option for you if you think that the rates are going to go down in the future. But the problem with that is there is a bunch of uncertainty with that. They could very well go up, and then you're stuck in a situation where my house payment was $1,500 a month, and now in 5 years after they adjust, then it goes up to $2,000 a month, and that can really get people in trouble. I would
Yep.
I would really caution people about adjustable rate mortgages because there's just uncertainty with them. A fixed rate mortgage, you always know what your payment is going to be. And then, if rates go down in the future, you can always refinance it. And obviously, you'll have to pay new loan origination fees and incur that extra cost, but you know where you're going to be no matter what. So your rate will never go up. It'll never go down unless you refinance it, but it'll never go up. So a
Mhm.
fixed rate, I think, is always a better bet. I have a pretty high tolerance for risk in my own,
Yeah.
personal life and financial life, but that's one where I would suggest you take a more conservative approach
Okay.
because it's where you live, right? I mean, it's where you live, and the biggest payment that pretty much everybody has is their mortgage payment and their housing payment, and if that goes up by a significant amount, then it's has the potential to really put people in a bind.
It does. It definitely does. But in this kind of market where we've been in an inflationary period for some time, but probably by most evaluations or estimations, we should be starting to turn over, right? Is there any uh, kind of advice for people? Hold off or just go straight for adjustable? Anything that you can tell us about what we should do in a specific economic environment?
It's interesting that you ask that question. I mean, the mortgage rates are higher right now than they have been over the last
20 years or
4 or 5 years.
something, yeah? Like a long time, right?
Not really. It's funny. I mean, if you look at the last 20 or 30 years worth of
Hmm.
interest rates, we're pretty much where the average was. It's funny.
Okay.
People have a super short memory. I mean,
They do, yeah.
interest was super, super cheap, around COVID. The government was trying to, boost the economy and do all that stuff. And they dropped the interest rates really, really low. And people
Okay.
got, people just remember that. But the average interest rate for the last 20, 25 years is 7 or 8%. So we're actually right where the average is.
Okay.
So if there's an expectation that things are going to drop significantly,
Hmm.
I would caution people not to take that viewpoint. And this is something, these people that are trying to sell you loans,
Hmm.
you, you need to take what they say with a certain grain of salt. I mean, I've talked to several brokers, and they're like, this isn't going to be your forever rate. This is going to be something that you can refinance in 2 or 3 years. And I would just say, absolutely, do not go into a loan based on the fact that you're going to refinance it and get a 4% rate 2 or 3 years down the road.
Mm,
Don't do
great,
that because you don't
great,
know. If
great,
you
great
do,
advice.
if you do and you can do that, then that's great, and that's some extra money in your
If that
pocket. But
happens, right, right.
absolutely do not plan based on the fact that is going to
Great,
be the case.
good advice. Excellent. Okay, so you just explained a little bit about the mortgages, but I know that there are some uh, policies or plans from the federal government. What kind of loans does the federal government offer?
So the federal government doesn't actually offer any loans, but what they do is they have programs that will basically
Ah, yeah.
guarantee a loan, and so it makes it easier for people to get into. So one of the big ones is an FHA loan. So with
Okay.
an FHA loan, you can get in with, I think generally 3%. I think there are also FHA loan options where you can get in with 0% down.
Okay.
So you
Okay.
have basically to pay the closing costs. So that's a situation where it's less money for you up front. They also have FHA loans generally have um, lower interest rates than a conventional type mortgage.
Hmm.
There are also USDA loans, which
Okay.
again, I think they give you options where you can get in with zero down payment or a much lower down payment.
Hmm.
And these are all things that you need to ask your lender about. So they should bring these things to you and tell you about them, but ask.
Yeah. So is this something for only the first time buyer?
No, they do have first time buyer programs, which
Okay, but
makes it
they're
easier for first time buyers, but these do
mhm.
not necessarily these are not necessarily for first time home buyers. But that's a good point, actually. And the other thing about a first-time homebuyer program, a lot of these are specific to a state or a county or a city that you live in, where they give you assistance to get loans like this.
Hmm.
Um, so you need to look at your local options for that as well. But
Yep.
the interesting thing about first-time home buyer programs is it's almost never literally just for your first home purchase. It's if
Okay.
you haven't purchased a home within like 3 years or 5 years.
Okay.
So if you bought a house 10 years ago and you sold it and you've been renting for the last 3 years, you're actually considered to be a first time home buyer and qualify for those programs.
Yeah. Yeah. That is probably a misconception, and so really interesting and worth mentioning. It's definitely something that people can take advantage of. Probably something they may not have thought they were eligible for.
Yep, absolutely.
Okay, so as we've discussed all these different, uh, pillars or elements under this home buying umbrella, you mentioned people who are selling loans. Um, you know, what's the importance of professional guidance? You are an experienced uh, homeowner, and so who do you seek? What is your advice? How should we think about this when what's the importance of professional guidance in when buying a home?
Professional guidance is very important. Um, Again, you've got to consider that these loan brokers and these, lending officers at banks, they're trying to sell you something.
Yeah.
So they're, they're going to be trying to sell you something. So it's important to get some independent advice. You should talk to your CPA. You should ask your CPA if there are any other financial advisors. Maybe your bank offers you a financial advisor, or maybe there's an independent financial advisor that, their purpose is to look out for you and your personal financial well-being, right? So they're going to be able to advise you better than a loan officer or a mortgage broker, because their job is just to sell you something. And in many instances, they're going to try and sell you something regardless of the impact that it has on you. So just because you can qualify for a
Yeah.
$800,000 mortgage doesn't mean that you should. You've got to be comfortable with what the payment is. So this
Yeah.
is something that was a big thing that led up to the 2008 housing crisis. Was you had these banks selling people these mortgages that
Yeah.
they couldn't afford.
Yeah. Yeah.
So
So
get some professional advice, get some independent professional advice, and don't take financial advice from the person that's trying to sell you something.
okay. Yeah. That is probably one of the most important things that we've said today. So this individual would be found. So they're going to earn a fee separate of from the transaction,
Yep.
separate from the product that you are purchasing. Right. This is someone
Yep.
you have to retain a- additionally. Is it?
Yes, it's absolutely an independent third party. I mean, ideally, you would have some sort of a financial advisor that you work with from time to time that's already familiar with your situation.
All right.
There are I mean, you probably could find a person like this that would advise you specifically in, a single transaction, but it's something
Mhm.
that if you have an established relationship with somebody, they're going to be more interested and they're going to be more aware of what your situation is. So they're going to be able to provide you better advice.
Mhm. Yeah. Okay. So it's yeah. Potentially, our listeners would already have a certified financial, some sort of investment manager or something that they can ask, but there must be some source that they can hire or retain as well. I
Absolutely.
suspect. Okay.
There absolutely is. There are absolutely, and you can just do a quick lookup on Google for financial advisors, And, if you don't have somebody that you work with regularly, this could be a
Yep.
really good opportunity to find somebody. And it doesn't necessarily have to cost you a ton of money, right? But if you start working with somebody and building a relationship, then they can advise you with things in the future.
Okay. Yeah. Ask questions. Yep. That's why it pays to be proactive and to make relationships in your community. So, in addition to this, the professional advice, is there any kind of legal or financial compliance, like laws that you need to follow, or that could impact you, or could limit you, or this kind of thing? Is there
I
anything
mean,
that we need to tax
from a reg,
regulations?
there certainly are tax implications for all of this
Yep.
stuff,
Yep.
which I mean, that's a whole episode in and of itself. But you should definitely work with your CPA about any tax ramifications for any of this stuff.
Hmm. Hmm.
As far as all the other legal compliance, I mean, the financial industries are pretty heavily regulated. So one thing they're likely not going to do is break any laws. So you don't need to worry about that too much. There is a ton of paperwork. It's the reason that when you borrow money to buy a house, you have to sign a stack of papers that are that thick.
Yep.
I would recommend to everybody that, if you can get yourself into a financial position where you can buy these things with cash, that's much better. This house that I am in right now, I bought it with cash, and I signed literally one paper.
Wow. Wow. That's impressive. Yeah. So, yeah, very exciting and quite interesting. I suspect a lot of people out there are using their residence as a form of both wealth preservation, but also present income, especially in this really hot market, right? I think that there is a ton of discussion about the prices. Prices are high, right? But demand seems high. Um, it's just very interesting and important for our listeners to understand. Uh, so it's nice to hear you share, your personal experience. We know that there's a lot of hurdles uh, here, so understanding and preparing for them is definitely going to make a difference. So, with all that, is there any kind of final remarks, like what do you want to tell, what kind of message, you're in a really exciting part of the United States, and you have had great, I don't want to say luck, but fortune managing your current home. It's producing income for you, and it's allowed you to get out on the weekends and be real, kind of be mobile and have options. So these things are something people really envy and desire. What are your kind of final bits of information, advice, or guidance that our entrepreneur listeners would appreciate?
I mean, the whole purpose of this conversation was to talk about, how you get loans and stuff to buy houses as a self-employed person. And I mean, that's pretty straightforward. I mean, you want to keep the documentation clear so you can demonstrate what your income is. You want to have a good down payment. You want to keep your credit score in good standing. I would say, beyond the scope of that, by you just kind of mentioned this. One of the biggest, it's not just preservation of wealth, it's creation of wealth. I think that they've done studies on this, and I think the single biggest wealth creator is your own personal residence. And I would say
Yeah,
get there sooner rather than later.
yeah,
Figure out a way to buy a house,
sooner
as
rather than
soon as you
later.
possibly can. If you can buy a house when you're 22 years old, buy it, and then go on and buy another one. I mean, and then just keep going from there, because the real estate market is, historically probably one of the best sources of wealth creation in, I would say, the world historically.
Absolutely. Yeah, it seems so. And something that I would tell my younger self, some advice would be to, plan for the long term, which means, investing early. And so that definitely means, buy a house as soon as you can. Um,
Buy a
fantastic
house for
discussion.
buy a house for yourself, and then buy investment properties. I follow this podcast about people that invest in real estate, and this one guy
Yeah.
talks about how you should buy a house every year. And
Wow.
if you can start that process when you're 5, I wish I had started that process when I was 25, because if I had, I would have 20 houses right now.
Yeah. No doubt. I I
And
couldn't agree more.
think
Yeah.
of the equity that you would have if you owned 25 houses, and think of the cash flow that you would have if you owned 25 houses and were renting out 24 of them.
Yeah, man. Yeah, it's quite staggering and absolutely inspiring. So, wonderful information. Mark, really appreciate you shedding some light on the essential strategies and the options, the various, details, also the hurdles uh, for, that a self-employed individual might encounter when securing a mortgage. Thanks everyone for joining us today. Appreciate you very much. If you guys found this episode helpful, please share it and definitely leave a review. Also, stay tuned for more insightful discussions here on Smart Biz Advisors podcast with Mark and I. Until next time, everybody keep striving and thriving for your entrepreneurial dreams and endeavors. Goodbye for now. See you soon. Cheers, guys.